This is Chicago's very own WGN Midday News.
Coming up next, how to use insurance as a college savings strategy. We'll explain.
In today's Your Money Matters, we're going to talk about how you can use an indexed universal life insurance policy to help save for college tax-free. Michael Ruggiero is here from Ameriprise Financial. And he'll also be featured in the November issue of Chicago Magazine as one of the top 3% of financial advisors in Chicago. Michael, this is great to have you here.
Thank you for having me on.
I'm familiar with the traditional universal life insurance policies. How does this differ?
Well, this is a hybrid of a whole life and a universal policy, in so much as that the policy itself offers more options regarding death benefits, regarding premiums, and you have the ability to earn greater interest credits because the policy itself is actually linked to a major market index, in most cases the S&P 500. Any interest that you accumulate year over year, if there's a year where that index performs in negative territory, it's 100% principal protected, so you have no exposure to that, and when you need the money, you can take it out tax-free.
Wow, so you have tax advantages on that end, and you don't have to worry about the principal going down once you have locked it in at that level. Is that the way it is?
Yes, on a year-over-year basis. So if in year one the S&P is up 8% or 9%, you get your annual premium plus that interest credit of 8 to 9%. But if in year two the S&P is down in negative territory in any way, shape, or form, you still keep the principal and the interest that you gained from the prior year. And then when you need the money for college, for example, which is a great way to save for college, you can take that money out tax-free. It's like a Roth on steroids, if you will, because you're making the contributions with after-tax dollars.
And with interest rates being as low as they are across the board, is this going to give you better opportunity to make higher interest dividends on this than you would, say, I mean, of course, you put it in a savings account, you're getting virtually nothing now or anything.
Well, if you allow yourself enough time, you know, you're going to have children, they're going to go to college, you can hopefully get those historical rates of return of 8 to 9%, compounded year over year, and the money will be available when the children go to college, and you can take it out tax-free. And again, all of the principal and interest that you accumulate over that time frame will be protected 100%. So it's advantaged that way, and it's tax advantaged as well.
Are there different policies that exist? Should a person shop around to try to find one as opposed to another?
Well, you can shop around, of course, to see who offers a better index policy, if you will. There's newer products out there, products that are linked to the Dow or other indexes, but this is kind of new, and most of them are linked to the S&P because it has such a broader basket of.
And yet you still receive the traditional life insurance protections for your family.
You get the death benefit, whatever that may be. Any cash value gets passed along tax-free. You can take that money out tax-free to pay for college. Yes, it does offer the traditional benefits of insurance.
They sound like it's a very interesting way to take advantage of the compounded interest over years, and something you may want to look into. But for more information on it, the easiest way to do it is to visit AmeripriseAdvisors.com, and you can get more information there from Michael. Mike, thanks so much.
Thank you very much. I appreciate it. Take care.
Great.